Good evening. This is Ken Long from Tortoise Capital Management with a review of the core and turbo concept for swing trade patterns that we trade intraday. So we have a half a dozen swing trade patterns listed here. Washout, 5 days down, the 551W, triple screen, channeling, overreaction, and then any continuation pattern off of one of the basic swings. All of these patterns are worth holding overnight because we have a advantage in being in the trade until such time as the exit is hit. These all last anywhere from 3 to 5 or 10 days, depending how long the pattern is. And we have a temporary advantage in being long. So if we have a swing pattern where the initial criteria have fired, and we have an entry that was hit mechanically, we're entitled to hold that overnight as a core position using swing trade position sizing that accounts for the overnight risk. That can be a multiple of the gap stat, it can be a multiple of ATR, it could be informed by support and resistance levels. But in any case, we have a level of risk that is appropriate given that we're going to hold it in the aftermarket session. As long as the swing trade position is open, we have reason to believe that upward price move in intraday is part of the reversion to the mean or the resumption of the primary trend, continuation of momentum. Whatever the initial idea or the central idea of the swing pattern is, favorable price action intraday can be interpreted as a realization or a manifestation of that basic swing trade idea. And if the swing trade target is outperforming SPY or the S&P 500, the market, on that day, and the market happens to be going up, then what we can say is that the target has buying pressure and is being supported by the market itself, and so now we have a low-risk idea to trade intraday using intraday levels of risk. Now, the overnight holding risk level may be 2 ATR or 3 ATR. It could be $1. Intraday, we might be able to manage 25 cents of capital preservation or initial risk, and that would be perhaps using support and resistance or the morning hook or the WMB entry technique. In any case, we have a reason to believe that we have a favorable entry where we can see intraday targets that offer us 2 to 1. And so we might have a core position with $250 of risk capital divided by $1 of initial risk. We might have 250 shares of a particular target. Now, intraday, we may be able to fire another bullet at this, $250 of risk capital, but with a 25-cent initial stop, we can have as many as 1,000 shares. So this diagram now shows a condition where we're holding a core position, let's say, of 250 shares overnight, and then the next day we have the condition where SPY is up, and the core swing position is up, and it's outperforming SPY. And now we're entitled to add perhaps a turbo position of 1,000 shares with a 25-cent initial stop. So now we're carrying 1,250 shares intraday in the direction of the market, in the direction of the core swing position, and at some point we need to sell those 1,000 shares of the intraday turbo position in order to carry only an appropriate overnight risk level with the core position of the swing trade. And we can keep doing that as long as the exit signal for the core position has not been hit yet. So we might have a core position overnight. The next day is favorable when the market is open. We find an opportunity to buy a turbo position. We hold that as long as we have an advantage. We cash that. If we're fortunate, we may be able to generate enough profit to cover the overnight swing position, and now we have a swing position that's using only market's money for the overnight risk. And so we hold the core position overnight. The next day, we may have SPY down, or the sector that the swing trade is in is down, or the target itself is down. And so now we can take a position on the short side to act as a hedge against our core position. That might be an equal number of shares, and then we're market neutral with respect to the swing trade. We might have a larger position on the turbo to try to put some money in the bank based on a short side opportunity. But the same logic will apply, that when we've experienced the move that we can expect to see intraday using the range stat perhaps, or support and resistance, or a multiple of ATR, whatever reason, we cash that turbo trade on the short side. And that could be also, by the way, a position in an inverse ETF. If we have a core position or a target for that swing trade that is an ETF, we may be able to use an inverse ETF in the case where it's going down and the market's going down. And now we have a nice hedge against our core position. So we can keep playing this core overnight holding for as long as the swing trade pattern is open, the stop hasn't been hit, and then intraday by reading market behavior and sector behavior and target behavior, we may be able to add to that position with a turbo intraday, knowing that at some point during the day we're going to cash that and revert just to the overnight core position, which is justified by the swing trade pattern. So that's the general idea behind core and turbo concept, a combination of swing trading and intraday trading in targets that we have framed in the usual way, and in which we're using risk management and position sizing to meet our objectives. This is Ken Long from Tortoise Capital. Thanks for your attention.